Alix. Welcome to Bloomberg Commodities Edge, where we focus on the companies, physical assets, and the trading behind the hottest commodities with the smartest voices in the business. Let's get right to that data dig where we look at the top market stories of the week. It is Earth Day and President Biden's climate summit, but there's some really interesting moves here under the surface. Let's take a look at oil and India. So this bottom panel shows coronavirus cases. India saw the world's biggest one day ever with over 314,000 new infections on Thursday. And India, hugely important for the crude market, accounting for about 1 in every 20 barrels of oil consumed globally in 2019. And you can see the reaction to Brent. It's small but significant, particularly as cases continue to rise. So something else that really is catching the commodity market abuzz is lumber prices. But check this out. Lumber crack spreads, the difference between lumber prices and the stumpage fee, basically what lumber companies pay to landowners for trees. Now, the margin for sawmills are exploding as prices for Louisiana pine saw timber hit the lowest level since 2011. And finally, Europe also ratcheted up its climate proposals with legally binding goals laying out criteria for green bond investing. A key part of the EU's plan is this, carbon permits. You think of it as the cost for pollution. And prices actually reached a fresh record this week and are now up about 40% so far this year. Let's stay with climate and get into the ring. President Biden promises to cut U.S. greenhouse gas emissions in half by 2030 as he opened up a virtual summit with 40 world leaders.
No nation can solve this crisis on our own, as I know you all fully understand. All of us, and particularly those of us who represent the world's largest economies, we have to step up.
I'm joined now by Victoria Cumming of Bloomberg New Energy Finance. How does the U.S. target now compare with other major economies?
So the target that was announced today marks a significant improvement in ambition. Previously, we calculated that if it had maintained the same level of ambition that it saw in its 2025 pledge out to 2030, it would equate to somewhere a reduction of around 38%. But he's now announced this 50 to 52% increase. So it does mark a significant increase in ambition, and it puts the US more on a par with, say, the UK and the EU, which have really sought to establish themselves as climate leaders.
How do you guys at NEF determine who's winning and who's losing? Because what China's going to be reducing or what India needs to reduce is going to be very different than what the US is reducing considering their growth profile.
Absolutely, it's a great question. So countries are free to decide how they structure their emission reduction targets. So they can choose different baselines, different deadlines, and choose different gases or sectors that they include in their targets. So it makes it very difficult to compare. So what we've done in a recent report is that we've used 4 metrics to compare countries' targets. So we've looked at, say, the change in absolute volumes, but we've also looked at the types of target that are preferred by emerging economies like China and India, where they choose to look at, say, emissions per unit of GDP or per capita. So we hoped that by taking all those together, it gives more of a kind of overall view of ambition and means that it's more of a kind of apples and apples comparison.
All right, Victoria, thank you very much. Appreciate it. Victoria Cumming of Bloomberg NEF. Time now for Commodity in Chief, where we talk to one executive in the commodity world. And today is Wendy Cromwell, Vice Chair and Director of Sustainable Investment at Wellington Management, which has climate change on the mind. It is one of the world's largest privately held asset managers, managing more than $1 trillion for over 2,300 clients in 60-plus countries. Family offices, endowments, pension funds, wealth managers, and insurers rely on them for investment advice. And like most everyone else, Wellington is focusing on assessing and mapping the physical impacts of 8 climate risks: heat, drought, wildfires, floods, hurricane, water availability, air quality, and sea level rise. It uses these risks to help make investment decisions and inform their existing portfolio. Now, they look for companies that can mitigate climate change, like using water and resource management, that have a strategic plan to lower carbon exposure, like using less oil and gas, that can adapt to climate change, like avoiding areas that will be hit by extreme weather events and invest in ways to build climate resilience, and that are public or private and create innovative solutions to help people and society manage those climate risks. So to do this, Wellington partnered with Woodwell Climate Research Center, a climate think tank. And that means using science to screen for problems and opportunities in its portfolios. Wellington is also a founding member of Net Zero Asset Managers Initiative, which sets a target for the amount of assets that will be managed in keeping with a 2050 net zero emissions goal. There are 73 asset managers on board, like BlackRock, Brookfield, Vanguard, Fidelity, UBS, with a combined $32 trillion in assets under management. It's real money behind the climate problem. So I recently sat down with Wendy Cromwell, who's been heading these initiatives for Wellington, and I asked her how this informs portfolio decisions.
When people hear that we're aligning portfolios with a net zero target by 2050, they automatically assume that we're going to be divesting from certain securities. We recognize that we can't just decarbonize our portfolios by selling out of securities, because we would not be insulating them from climate risks. Instead, we would be realizing the risks of physical climate risk in the portfolios. So we have to work with the companies to set science-based targets, to get them on that pathway to really decarbonize the economy and society in order to really achieve that objective of decarbonizing the portfolios or insulating them from climate risks.
Can you give me an example of that?
If we sell out of a company that is an emitter because of their emissions path or their emissions footprint, then they're going to continue to exist. You would need all of the actors in capital markets to say we're not, or many of them to say we're not going to fund you anymore. And then their cost of capital would go up, and then maybe they would make different decisions. But that's sort of a circuitous route to making an improvement in terms of the emissions profile overall. A much more direct route is to say we are owners by choice. We recognize that you have this risk. We would like to own your security, but we don't have to. So why don't we talk about your plans for the future? We believe that the low carbon transition is underway. It's only going one way. Good companies are going to have a strategic plan for grappling with it. What's yours?
How do you find those companies? Like, do you screen them as you would normally an investable asset, and then they go to you and say, okay, this is the one we want, and you're like, all right, let me run it through this filter, and then the conversation moves on?
The primary rationale for the partnership that we have with Woodwell Climate Research Center is to bridge the gap between climate science and finance. And so explicitly what we're looking at is how heat, drought, wildfire, hurricanes, floods, access to water is going to change over time, geography by geography. And the scientists help us with that. They create maps that show us what that change looks like. And then we overlay those maps with capital market insights, usually our holdings or the locational data of our holdings. So it's very visual. And we can see, okay, this company has more hurricane risk or flood risk or heat risk than this company. And that helps us both with our engagements, also with our active decision-making and investment portfolios. As you study physical climate risks, you realize that we are going to need new technologies, new solutions, certain businesses in the future to help society adapt, because we're not going to be able to mitigate our way out of these risks. They're already baked into the cake, if you will, over certain time horizons. And so once you understand that and where and what those impacts are going to be, you can say, yes, we're going to need more dredging companies. Yes, we're going to need more air conditioner companies. Yes, we're going to need more engineering companies to help us solve these problems. And so sometimes, or generators to solve these problems, sometimes we see potential in companies that they haven't yet recognized for themselves through the lens of climate risk. And that might sound like climate capitalism, but it really is us trying to invest in solutions that are going to help people survive these changes.
That was my interview with Wendy Cromwell, Vice Chair and Director of Sustainable Investments over at Wellington Management. All right, time now for our commodity kicker. Iron Man is making a big squeal about fake bacon. Actor Robert Downey Jr. is investing in an alternative protein startup that makes bacon that sizzles and tastes just like the real thing, but it's made from fungus. At Last Food has raised $40 million to help build the world's largest farm for a type of mushroom root that's a key ingredient in At Last's products. Avenging the pig is a juicy proposition. The market for alternative protein could blast off to reach $290 billion by 2035. That does it for Bloomberg Commodities Edge. Catch me every Thursday at 1 p.m. New York, 6 p.m. in London. This is Bloomberg.